Today, a deeper dive into current loan-to-income ratios. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to today's post, in which we discuss the latest finance and property news with a distinctively Australian flavour. The enhanced focus on mortgage lending serviceability means that a consideration of the loan-to-income ratio, or LTI, is ever more important. In the UK, where LTI calculations are the norm, the Bank of England first introduced limits on high loan-to-income mortgages in 2014. These measures meant that no more than 15% of mortgages issued should exceed a loan-to-income ratio of 4.5 times. The actions were not retrospective and few British lenders were impacted by the curbs. The UK's 4.5 times LTI cap on 85% of new lending is still in place. And in June last year, the Bank of England Governor Mark Carney announced that the 4.5 times ratio will become structural features of the housing market in the UK. Now, last month, APRA, the prudential regulator here, announced that it would remove its 10% benchmark on investor loan growth for banks that could confirm that their policies and practices met a range of expectations. One of APRA's expectations for banks is a commitment to develop internal risk appetite limits on the proportion of new lending at very high debt-to-income levels, where debt-to-income is greater than 6 times a borrower's income, and policy limits on maximum debt-to-income levels for individual borrowers. So it should be of no surprise to note that Commonwealth Bank of Australia has announced that it's brought in new debt-to-income measurement for borrowers. CBA, who's the largest owner-occupied mortgage lender in Australia, has disclosed that it will now monitor loan applications with a debt-to-income ratio higher than 4.5 times. It will also bring in new e-learning requirements for brokers that have not settled a CBA loan for more than a year. Applications with a debt-to-income ratio higher than 7 times will be subject to a manual credit approval check. The new measure will reportedly help the bank get a clearer picture of what its loan book looks like and help to understand trends. Speaking of the decision, Daniel Huggins, CBA's Executive General Manager Home Buying, said, "At the Commonwealth Bank, we constantly review and monitor our home loan processes and policies to ensure that we are maintaining prudent lending standards and meeting our customers' home buying needs. Our decision to implement a new debt-to-income measure is just another example of our ongoing commitment to responsible lending and meeting our regulatory commitments." Now, last year, NAB introduced an LTI ratio calculation of 8 times for all home loan applications, and in February this year, it was reduced to still a generous 7 times. The bank said at the time, NAB is committed to lending responsibly and ensuring our customers can meet their home loan repayments today and into the future. Now, we've been looking at the current portfolio view of all mortgages in Australia from a loan-to-income perspective using data from our core market model. This is based on our rolling survey of 52,000 households each year. The relative distribution across the LTI bands highlights relative risks in the system. Now, we took a cut of 6 times in line with the APRA guidelines, and on an all-portfolio basis across the country, around 7.9% of all loans have a current loan-to-income ratio of 6 times or more. This is based on current loan values and current incomes, not those considered at loan inception. But there are some significant state variations. For example, loans in Western Australia have around 6% of loans with a loan-to-income of 6 or above. In the West, the proportion is rising as incomes remain constrained despite loans growing a little. This is thanks partly to capital being released via refinancing. In South Australia, only a very small proportion of loans have a loan-to-income of 6 times or more. In Queensland, the total proportion above 6 times is 2.8%. However, things get more interesting in the eastern states, with 7.1% of households in Victoria holding a loan-to-income ratio of 6 times or higher. But the prize goes to New South Wales, with a massive 15.8% of households currently holding loans with a loan-to-income ratio of 6 or more. This is, of course, explained by the high prices, big mortgages, and loose lending standards. This analysis provides some insights into the pressure on households, as these higher multiples are indicative of larger payments being made to service the loan. Thus, we conclude that the most severe issues will be found in New South Wales, where, of course, house prices are now firmly on the slide. We will publish our latest mortgage stress data to the end of May, early next week. But finally, consider this. When I was a banker, the rule of thumb was 3 times one income plus 1 times the second. How the world has changed. Before I sign off, I wanted to highlight our planned live question and answer session, which is scheduled for next Tuesday at 8 p.m. Sydney local time. This will be streamed live via YouTube, and I plan to take questions via the built-in YouTube chat facility. The session will be posted as normal afterwards, so you can choose to send questions through over the next few days. Join me live at 8 p.m. on Tuesday, or watch the session afterwards. I hope to see you there, and remember to mark your diary. I will be putting up a scheduled event shortly. If you like what you've seen here today, please like the post and add a comment or question. I read them all. If you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.